Ski ba da ba da ba doo ba doo ba dee ba ba boo beep ba dee bee ba da doo 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 ba da ba ba ba. Yeah.
Hey, folks, and welcome again to another fantastic episode of Financial Fitness with Patrick, presented by Soaring Prophets Media. And this is a guest that I've been sort of looking forward to for the last little while. Chris kind of speaks my language, his lingo. He is a technical trader, and he is the founder of thetechnicaltraders.com. We've got his link down there in the bottom. Please make sure to check it out. Chris Vermeulen, joining us all the way from Collingwood, Ontario, probably getting a little bit of snow as we're speaking right now and enjoying some of that beautiful winter powder for that ski, beautiful resorts up there and a beautiful Georgian Bay area as well. So, Chris, thank you very much for joining us today.
Hey, thanks for having me, Patrick. It's a pleasure to be here.
Thank you, sir. So, Chris, obviously what you've done here with the technicaltraders.com is kind of a unique space. You're looking at investing individuals' money with a little bit different mindset than plug it into an ETF or plug it into a mutual fund product and leave it, set it, and hopefully you're going to garner your, 6, 7, 8% in perpetuity for the next few years. Maybe you can talk to us a little bit about what your strategy entails and why it potentially offers your clients a little bit different style of return, maybe a little bit easier to generate capital from that.
Yeah, so the stock market is a pretty big beast. It takes forever to master, and you always have to be on it and learning. But I kind of look at the stock market from a very different way than everyone else. You've got two camps when it comes to investing or being involved in the stock market. The first one, which most people are passive investors. They do the buy and hold. They're diversified among different stocks and sectors and bonds. And they leave it there to more or less age or go through that roller coaster ride that I think most investors have experienced. That's kind of the traditional way. The other way is you become an active trader and you try to make huge returns. But the reality is, the more you trade, there's all kinds of studies across North America and Brazil and a bunch of different countries that show the more you trade, the more you lose. And so active trading is an extreme sport. And doing nothing, on the other hand, is also an extreme. And so what I do in the markets is I use technical analysis, meaning I follow the price trends of charts, and I literally just make adjustments to our portfolio to hold only the assets that are going up and get rid of any assets that are going sideways or falling, so that we're literally just rotating our money through the market into only one asset class at a time and riding those higher. So instead of owning 1,000 different positions or 500 different positions or whatever it is somebody has, we own one position at a time in our portfolio, which we can get into. But it's a very different view than what any financial advisor does and what most people think and do. So we move just enough in the stock market to catch these waves that happen in the markets. And the best analogy here is to think of the stock market like the ocean. You've got a tide, and when the tide's going up, it lifts pretty much all stocks, lifts all boats. When the tide's going down, the boats go down. When the stock market's in a bear market, all the stocks pretty much go down. There's no point in trying to pick the one needle in a haystack that's going to go up while the rest of the market's falling. So if you understand if the tide is going up or down in the stock market, then you know what strategy you need to deploy. And then I like to think of it, I'm a surfer, kiteboarder, so think of a surfer just floating out past the break. If you're down on the ocean, they're all sitting out there peacefully, just letting the little waves, the chop of the market of the waves of the ocean kind of go by, and they're waiting for that clean set of waves to come rolling through. And they can see them coming, just like we can as a sophisticated technical investor. We can identify sectors where money is pouring in. There's a strong movement in that asset. Those are our waves. So we wait, and when we see one of those coming, we can hop on, pick the asset that we like, that's the strongest, that we are the most comfortable with, that fits our risk level. And then we hop on and we ride that investment up. And the nice thing about catching a strong wave is you can also tell when it's starting to lose power. So we know when to carve out of that wave before it curls and crashes. We can get off that investment. And then we sit and we float with our capital either safely in cash or in another wave that is rolling through right behind it that we can hop on. And that's kind of what we try to do. So if something is going sideways or falling, we could just be sitting in cash collecting daily interest, waiting for another opportunity. And there's about 5 to 12 of these that roll through the market every year. And it's just about being patient and managing positions.
So Chris, with that, you're obviously looking at specific indicators that are bringing that up. You have relative strength indexes, you have, your moving averages, that sort of thing. Maybe you can give us a little bit of a pull behind the curtains to some of the indicators that you're using on your charts on a daily basis, a weekly basis, or are you trading longer term? Are you looking at the weekly, monthly type timelines? How are you positioning yourself in those asset classes? And then what are some of the indicators to get out? What are you seeing? Are you looking at volume drop? Give us a little bit of a pull behind that curtain on what you are deciding using to make your decisions.
Yeah. So I just did a mentoring session with a bunch of investors today, and this was one of the topics of what are the indicators we use, and people rhyme off all these indicators that they use.
Yeah.
And this is where people really need to try to understand. Most indicators on a chart are all based pretty much around the same thing, the price action of that particular chart. They just find all these fancy ways to show it in a different way.
Elliott wave, all the, yeah.
Yeah. So there's different types of ways to break down the price data, but it's still based to that price. So if you have 10 indicators, they're really all just using the same information. And so what I do that's very different is I call it intermarket analysis. And I say that because all the markets, all the different asset classes, real estate, currencies, commodities, the stock market, interest rates, they're all interwound. They're all interconnected. And so the stock market really, in the stock price you're following or whatever it is, that's just one data point. We want to see what other related assets are doing, because when something moves in a market, it causes a ripple across pretty much every other asset in some way. It could be delayed. You might not see it show up, but if we know what all these different assets do and how they're interconnected, and we can track the money flows in or out of them, that allows us to identify the mindset of the investors. So not only are we identifying the price of the individual asset we're following, but then we're following where the big money is flowing through all the different assets, which way it's going. Are people moving to defensive utility sector, healthcare, gold, whatever it is, or are they, going the other direction? So I use price, technical analysis of price. We follow sentiment, which we get through more or less looking where money is flowing into the markets, different markets. We use time cycles. We look at the daily chart. We look at the 30-minute chart. We actually also follow the weekly chart. So we break things down to multiple time frames. So the weekly chart is like the ocean tide. That trending chart tells us, hey, is the stock market in a bullish phase or a bearish phase? The daily chart is more of the short-term waves that we're going to catch. And the minor analysis allows us to help time our entries and exits for locking in profits, moving up stops, and all those things. So we do use moving averages, like you mentioned, and different things like that, that just help us identify, the trends. A long moving average tells us the longer term trend is either moving up or down, and shorter term tells us if we're in a short term up or down trend. So we use some of those things, but really we use a lot of different, every piece of data we use is almost a different piece of data that we're analyzing. So emotions, money flow, stock market, volume through the New York Stock Exchange, is it flowing in, flowing out? So there's a lot that goes to it that creates our strategy. And the nice thing is our strategy is an end of day strategy. So we let the market close, we get the complete data, and then we know if we have a signal at the end of the day. And of course, we only have 5 or 12 trades a year. It is very passive compared to the active trader. And then once we have a signal, we literally will either send out an alert, or you can have it auto traded for you for like a user if they wanted to, so they don't actually have to learn or do anything. But we enter the next day at the opening bell, and if we hit a profit target intraday, the broker automatically you'll have target orders and stop orders. So once we have our entry, we can place most of the other orders, and it can be executed by your broker or have it done for you. So it's a pretty slick strategy. And the nice thing is we can see trades coming a week or two out. We can also see when they're going to end, in a couple of days or potentially in the next week or two. So we're never caught off guard because we understand the flows and the momentum, and things are stalling and running out of speed or picking up speed. And that's what's really valuable, is we're never really caught off guard. We know what to do no matter which way it goes, because we manage our positions. We manage our risk, which most people don't do. A lot of people will overcommit to an investment, and they have no real reason of how much they throw in. They're like, I'm going to throw 5,000 in here, 50,000 in here, but they don't realize how that plays in if it goes the wrong way. And they usually don't learn the damage until it's done. And it's too
Right.
late by that point.
Well, so I think that, Chris, that brings up a really interesting facet, right? Is risk mitigation. So it sounds like you are mitigating risk because you're exiting trades before topping patterns or at topping patterns through the technical analysis piece. So the average passive investor is likely buying a mutual fund type product. They're sitting back. They're hoping that over their 30 or 40 years of investment, that they're going to get the ebbs and flows of the market, and they're going to end up positive, right? That seems to be the passive strategy for most people. Now, for you and your strategy being a little bit more active, what sort of returns are you generating? Obviously none of these are proficient moving forward, but what sort of historical returns have you garnered for your clientele?
Yeah. So if you look at like the stock market or the average portfolio over like the last 10 years, it's only like 6 or so % return a year over the past 10 years. Because we're only holding things going up. And then when the stock market falls out of favor and starts to fall, and we move to a different asset like the dollar index that's going up, we can still generate profits while the market is falling. And sometimes we'll just sit in cash and we'll still collect a third of an interest in just literally interest dividend payments through a different ETF each month. So, we're averaging about 15% return a year over the past like 15 years or so. Which is pretty incredible. And the part that people don't fully understand is our max drawdown on this strategy. So the maximum that we've lost, put it this way, the buy and hold portfolio is about 38%. The stock market is anywhere from 50 to 85%, depending on the index. We're less than 6%, which is what is so powerful about it is people can invest more of their life savings or portfolio, their retirement account, and feel very comfortable knowing like if we have a bad streak, it's not like we're going to lose our shirts. And that's what the strategy that I use is called CGS. It's called the consistent growth strategy. And it literally just inches higher and higher. Doesn't matter if the market's going up or down. We're either earning interest or in something going up. And the 2022 crash where most portfolios fell 25+%, we just inched our way up about 6% higher, which isn't much, but that's a 30% spread between the average investor. And there was no stress. It was very comfortable. We all know what's going on because we can see it in the markets. We understand what's going on. And that's the big thing. And the buy and hold portfolio, you see these investors, they buy the stock market and bonds and they hold it forever. And they believe in diversification. And I don't believe in diversification in the stock market. And this is what I think shocks a lot of people is if you own a whole bunch of different sectors and stocks, some are going to do really well, some are going to do really poorly. And then, that kills your gains. So you end up with that average return, which is the buy and hold return with a huge roller coaster ride with it. Not very good. I believe the stock market as a whole is one asset class. You either own the stock market or you don't own it at all. So there's no point in spreading it out. So when we move into the stock market, we are buying the SP 500 and the Nasdaq. We split our portfolio between the two. Sometimes only one of those indexes will give us a buy signal, but we move into the stock market, we ride the market up. When it starts to stall, we move out, we move to a different asset. It could be bonds, it could be a currency, it could be cash. So we have one ETF position open at any given time. Pretty much. And that's what shocks most people. They're like, how can you manage your whole portfolio with one position? Well, that's because we believe in owning only the best asset that's going up. Why would you hold ones that aren't doing as well and don't have as much potential? So we just rotate our capital and we manage those positions by moving our stops up, pulling out profits as it hits targets and moving that cash into a dividend paying treasury note fund. So it's pretty interesting when people are like, wow, you don't diversify at all within the stock market because it's just like the ocean. If it's going down, you don't need a whole bunch of stocks falling and crashing really fast. You might as well just get out and catch the tide.
The diversification aspect, Chris, for myself, I have a very similar mindset of yourself. I have about 3 holdings, and my whole viewpoint is that if I chose the wrong one, why am I sitting on it?
Yeah.
Right. Like if we're seeing it pull back, we're seeing a big problem like that. Let's cut bait and move on to something else. So why would you put your eggs in baskets that you don't trust?
Yeah.
Like the diversification aspect. And again, I understand that if you're a money manager and you're managing trillions of dollars, hundreds of billions of dollars, and all you're responsible for is trying to garner 5 to 7% every year, and you still like to ski and kite surf and all the fun stuff that goes along with that. Uh, the diversification aspect, I think, has put a lot of money in a lot of advisors' pockets because you have to have lots of meetings about your holdings. And I absolutely agree with your concept in regards to if you can find asset classes that are moving. And, I kind of think that brings us to where we are today. We had the CPI, if that's the name that you want to call it these days. We had the unemployment numbers that have come in out of the States. And, we saw the market, the QQQ specifically this morning, pull back in a heavy way and then rally to a positive day. And, we've seen this Magnificent Seven. We've seen the AI rally from October when we were seeing that chop, that downward, was it a bear market? What's that going to potentially pull into? So, we're not prognosticating into 2024. We don't have any crystal balls, but Chris, where are you folks positioning yourself now into a 2024 that potentially has a lot of tumultuousness in the waters, as we're using that analogy? And are there sharks waiting? Are there going to be some headwinds or tailwinds that are going to be pushing this market from a technical perspective?
Yeah, I mean, I'm totally against the traditional way of investing. The sharks to me are more so advisors because they do the buy and hold. They cause like they're investors to put the risk their money and to just plop it in, and they all just say, just hold it, you'll be fine. Time is money, and yeah, they will most likely recover.
Timing the market, yeah.
But it's really frustrating when people I know who are in retirement or close to retirement and they see their accounts fall like in 2022. It's devastating. It completely changes their outlook for the rest of their life, all because their investor just said, just keep holding it. Yet their bonds fell like 40% and completely crushed them. And bonds were more dangerous than stocks.
Did you ever think, like, you are a young man, you are, close in age to myself. Did you ever think that bonds would be sexy like they were in 23?
I know. I mean, bonds are fast moving. Believe it or not, the TLT Treasury Bond Fund in the States that I follow, it moves like 15 to 20% quite frequently. It rallies and sells off. It's more volatile than people expect. I think bonds are going to have probably a pretty miraculous comeback at some point, but it still might actually take a couple years to base out and all that stuff.
So you gave away your hand a little bit there. If you're thinking bond yields, the TLT is going to bounce back. Do we think that we are potentially going to see yields increase, putting pressure on the dollar, and therefore are we into a bit of a bear cycle and a longer term play?
I think 2024 is going to end up being a pretty ugly year for stocks. I think bonds might hold their ground. They might pull back a bit, but I don't see a massive rally really starting in bonds anytime soon yet. They've had a strong bounce, but they're still clearly in a very strong downtrend in the market. So, yeah.
Yeah, I think that's the issue is that, do people want the U.S. debt right now? We're into these foreign conflicts where does Japan still want to buy from us? Do they want to hold our debt in these situations? And that's where I think, the kind of that larger viewpoint, that macro viewpoint of where we are sitting in this timeline is really going to be an interesting one when we shake out history. There was a few articles that were written over the last week or so in regards to the job numbers of the United States. And you can put your conspiracy cap on if you will, but when job numbers continue to be revised down month after month after month after month after month, and the CPI coming in with the deflationary aspects, deflation, I don't know. We are getting information that seems to be a little bit tainted, in my opinion. We'll see what that looks like. But again, with what you're doing with the technical piece, those individual items of information kind of get factored in on a macro level where you're not waiting for each individual piece of data, is that you're taking and looking at a totality of the situation and investing. But how does algorithmic trading, how does, the process of market makers pushing and moving through open interest, how is that kind of that manipulation? How are we seeing that in the market, especially after the last little while, affect a technical perspective like with what you're doing?
Yeah, I don't really think it affects things actually that much. I consider politics, news, the Fed, all that stuff is BS. It's just frustrating. People try and trade around it or trade with it You never know when news is coming out. You never know what the Fed's going to say. And if you know what the Fed's going to say, the market always does the opposite as you think.
Right.
Algorithmic trading are systems that pile into the market. When there's a lot of volume pouring in, they become really active and they generally try and drive a trend, which is not a bad thing. So there's always going to be that type of manipulation, that kind of chaos in the market. You can't really gauge it. You can't time it. So you just have to accept the way that it is. And that's the nice thing about technical analysis. I haven't watched TV or read the news. My kids tell me when there's COVID. Like they literally tell me anytime there's a big event going on. They're 11 and 13.
Right.
Because news is nothing but negative. And all I have to do is spark up my charting platform. And in seconds, I get a feel of where the money's going, because we don't need to pick a top. We don't need to pick a bottom. All we need to do is follow the charts. And if the trend and the momentum behind is big enough, if it's a big enough wave, all we do is we move into that asset, we hold it, and we follow it. And so we never get out at the top. We always wait for prices to turn around and start to head lower. And then we get out once it's confirmed. And we never buy in near the bottom. And we have to wait for that trend to change and then generate a signal. So we're all about just trying to catch that middle safe chunk using technical analysis, weeding out all the news and all those things.
I love it, Chris. And how do people get in touch with you? I see that we have your QR code there set up. James, the producer in the background, has put that together for us, and that'll take you to your website. So how do people get in touch with you? And then more importantly, with what you're doing for individuals and generating that, legacy wealth that they can continue to pass on to their children, how do they put some money in your pocket so that they can work with you?
Yeah, so they can go to my website, which is thetechnicaltraders.com, or just type in Chris Vermeulen and you'll see my face probably pop up everywhere. But I should be clear. I do not manage people's money. I run a newsletter. So I build the strategies. I use it to trade and invest my own capital. I share everything that I do. So if you become a subscriber, you can join. I literally share every trade and all the details with you. If you have a mobile phone, boom, you get the alerts on your app, on the phone, or you get it through email. You just copy my trades. I say, buy this ETF tomorrow at the open with 100% of your portfolio. Once we enter it, I say, here's our entry price. Here's where you need to put your stop price. Sell, 25% at this first target. And then we just update as the trade matures and unfolds. If you don't want to learn the markets, which it is a never-ending process, which most people will never actually really master because it is extremely difficult if you don't live and breathe it. We have auto trading. So you can literally have the trades automatically executed in your brokerage account. I don't charge anything extra for that because it's actually the best way, I believe, for people to have their money traded, because I can give out a trade alert and people will be feeling the emotions of the markets because it's pulling on them, because they don't fully grasp the same depth that I do. And they'll be like, I'm not comfortable. I'm not going to do this trade. And of course, the ones they skip are the biggest ones. The ones they take are the ones that, are the duds, or the ones that don't take off. It's the way the markets work. And the auto trading literally kind of just allows them to sit back. And when the stock market's crashing for a couple of weeks, they can log in and be like, oh my gosh, my account has been going up. I totally was not expecting that. And that's what we get all the time. They're like, I cannot believe how passive the stock market can be if you don't want to try and learn the game, which I don't really recommend people do, to be honest. I literally, unless you're going to spend the rest of your life doing it and you don't live and breathe it, you're best to just have things done properly with an expert, really.
Absolutely, Chris. I couldn't agree with you more. And again, with what you're doing, that technical analysis side of things, as opposed to picking, these random movements or trying to get a hot tip from a guy at the gym, or, the crazy things that are out there in the world. It sounds like you've got a really good head on your shoulders and positioning yourself and your newsletter in that light. So, Chris, I want to thank you so much for joining us on Financial Fitness today. And again, folks, the market is such a fickle beast, but there's a lot of tells. Right? When we talk about some of the patterns, some of the technical analysis pieces, there are hints to where we are going with this. So talking with someone like Chris, you can get some insight, some information, and you can start making decisions for yourself. And, a lot of people look at it as gambling. A lot of people look at it as a number of different things. And I hate kickers. So I'm not one into the football gambling game, but this is one that I truly love and enjoy, and learning, exactly like Chris is saying. So from myself, folks, get in touch with Chris, check out his newsletter. And from me, as always, let's make some money together, folks.